Hi, this is George. In this video, we are going to see about adjustments to Straddle or Ironfly. Before getting into the video, please do subscribe to this channel. Also join our Telegram channel for instant updates. And please do like the video if you genuinely like it. Let's get into the video. So in this video, I have covered some 15 basic adjustment types. These adjustment types can be used irrespective of any base trade. It is not necessarily that it is applicable only for a straddle or Ironfly. It can be even used for a strangle or iron condor or any strategy, you name it. You can use these any of the trade based on the market behavior and the capital that you have. So this strategies that we do is we do only when the break even is breached. Disclaimer, this is only for education purposes. Please do your research before taking any trade on the adjustment that we are going to discuss. This is not a recommendation, but just my view. There are many more adjustment strategies, obviously, but these are very few basic adjustment strategies that every trader should know before going for trade. Let's get into the core of the video. So I'll just take you to the Opstra. Now what I'm going to explain is maybe I'll take a weekly option of Banknifty, which is about to expire on 12th of May, and for that we are going to start the trade by 5th of May around 3 p.m. So we are going to sell a ATM call and put, and we are going to buy 1000 points away call and put, making it to an Ironfly. So now the ATM price is 35,300. So we are going to sell 35,300 call and put. And we are going to buy 1000 points for OTM in both the sides. So once we do that, our PF chart is going to look like this. So in this I have given what is the old break even in the downside, upside, max profit. You can just see old is before doing any adjustment, and new will be after adjustment. For now you can just focus on the old one. So I mentioned is 34,641 to 35,959, and max profit will be 16,451, and max loss is 8523. Here I have given max loss in both the sides. So when you start it both the sides, it is going to be equal in the loss. So it is same here. Now let's see our adjustment. What would be our first adjustment? The first adjustment is booking profitable leg in sell side. So this is after a break even is breached. In this example I have taken because the next day morning at 9:30 only the break even is getting breached. So we are going to make the adjustment in the very next day. So the first adjustment is, as I told, booking profitable leg in sell side. So sell side we are getting profit from call side. So we are going to book this profit in the call side, and we are going to sell a ATM call, which is 34,600 call. So once we sell this, our payoff chart will look like this. In this you can see we are extending the break even in the downside, also the loss in the downside, but in the upside we will be getting more loss. So as I mentioned, from 34,641 it has gone to 34,352, and in the upside, as it has declined in this side, from upside also it will go down, which is negative for us. But as it is already breached in one side, we have to be careful on the side that it has breached. So we might have to take this trade based on we are little protected in the downside. By doing this, our max profit also has reduced from 16,000 to 6,000, and max loss in this side is only 1,200, and max loss in the other side is minus 18,000. So this is the first adjustment type. So second adjustment type, booking profitable leg in buy side. I'll let you know what is that. First we'll get back to the normal how it was before. Okay, so it is breaking the break even. Now we are booking profitable leg in buy side. So buy side we are getting profit in put side. So we are going to book this profit and we are going to buy a ATM put, which is 34,600 put we are going to buy. Once we do that, our break even will be like this, where actually the break even has moved little more towards our other side, because these things we'll do when we feel like market is going to reverse and it has already fell so much, so it might reverse. So we are taking these kind of things when we are our break even is like kind of shifting to this side, that way it is shifting here also to little inwards, but our max profit is not cutting down so much, and our max loss is also like this side it is like only 4,000 in the downside, and in the upside it is 11,000. So comparing to this strategy, we will be applying this strategy when we feel like market is going to reverse, and if it doesn't reverse also, the maximum loss is going to be 4,000. So that is when we will be doing this adjustment. Next adjustment is booking loss making leg in buy side. Booking loss making leg in buy side. So in buy side, the loss making is this call leg is making loss. So we are going to book this, and where we are going to buy is like based on our previous video. If you have seen, we will always do the reverse buying strategy, in which we will only move if there is a gap difference of 20 points between the two strikes that is before is. So maybe like 44 minus 37 is less than 20. Similarly, we will go to an extent where we get difference not more than 20. So in this case, if you see, we can just roll up towards till 122, because 143 minus 122 is more than 20. So till 122 we can go. We are going to buy at 122. So once we do this, our payoff will look like this, where we absolutely have no risk in the upside, and we will have loss in the downside. But in the upside, you are totally free, and you do this again when you feel like market is going to go up. So as I said, like this here also, like a downside as little it has come to not in our favor kind of thing, but upside there is absolutely no break even. No matter where it goes, we'll be in profit. And here our max profit is also like if it is reaching this peak kind of, it is like almost 14,000, or else also it is almost 7,000 here. And our max loss in the downside is minus 10,000 in the downside, and there is no loss in the upside. This is the third adjustment type. And the fourth adjustment type is booking profitable leg both the sides. So we are going to book profit in both sides. So we are getting profit in 35,300 call that we sold. So we are booking that, and the call that we are going to sell is 34,600. Similarly, we are getting profit in the call that we bought at 34,300. So we are booking the profit here, and we are going to buy 34,600 put, which is the ATM. After doing that, when we check the payoff chart, it's going to be like this, where there is absolutely no downside risk, and upside only if it moves again somewhere around 800 points, we're going to get a loss. 35,477 is the, okay, maybe I would have taken different stake that time. I would have like 10-15%, maybe I would have taken different, like one stake above or below. So what the main thing you need to know is like here, If we do this strategy when we feel like market is keep going downside only, we can take the strategy. Even if it reverses to an extent till we'll be in profit. If it goes more drastically reversed and if it making a sharp remove, we'll be in loss, or else we are like protected. If it happens that way, we'll have a very big loss. But if it is keep going in the downward direction, we'll have a limited profit. So that's what you can see from this line. Then we'll go to the next adjustment type, booking loss making leg both the sides. Let me just go back to the normal way how it was before doing any adjustment. So here booking loss making leg both the side. So here this is making a loss put leg that we sold. So we are going to book the loss here, and we are going to sell a 34,600 put. Similarly, we are going to cut down this loss making leg at 37, and we are going to buy a 34,600 call. By doing this, you can see like we don't have any break even in the upside, because upside we are totally protected. In the downside, we are not decreasing our break even much, but our max profit is like more in the upside, and also our max loss will also be up. But still, if we feel again the market is going to reverse, it has already corrected so much, then you can apply this strategy. Then we will go to a different strategy called shifting. So what exactly shifting is, I'll explain. Say maybe like once this break even is breached, that is like at 9:30 of the next day, when we saw that the break even is breaching, we just book loss in this strategy. So see, the maximum loss is 8,500, but even after making a very big move, we have like sold 35,300 ATM call option put option, and market has moved almost 700 points in a span of like 45 minutes. That is next day opening, it was a big gap down. So even then our loss was only like somewhere around 500 or 600. So what we do is we totally exit this position totally. So we book a loss of 600, and what we do is like where we are right now, 34,600, there we shift our position. So we move our position totally to 34,600 call and put we sell, and we buy 33,600 and 35,600 as a hedges. So once we do this, our position will be again totally like the normal how it was before, giving us a wide range. Like from old it was like 34,641 to 33,933, and here it will reduce obviously, but our max profit is going to remain almost the same, and our max loss is also going to be always the same. So here we are like extending almost like we are coming in the center point again, but we are doing it safely. That is because we are like we have booked only 600 rupees loss, or else if it is going in a negative way, we would have ended making a big loss. So this is called shifting. The next strategy is averaging. So before going into that strategy, let me get back to how it was before, so that I can explain the remaining strategies. So 35,300 we have sold, and 34,300 we are buying the both sides. Sorry, 1,000 points away we are buying in both sides. Okay, so this was how it was looking, and by 9:30 break-even was breached. Now we are going to do an average at the ATM price. Doing an average is like we are going to do one more Straddle Ironfly here at the ATM of 34,600. So we are going to sell one more lot of 34,600 call and put we are selling. This time we are not shifting, but we are doing an extra set. 33,600 and 35,600. By doing this, our payoff chart is going to look like this, where our break even has reduced 400 points downside and it has little reduced in the upside obviously, but our max profit is still going to be more, and max loss will also be twice how it was before. The reason being, now we are having two sets of the four legs, so we are having 8 legs now. So obviously this will also be 2 times of our max loss that we saw, but max profit is going to be the same because last time only we know that this was the maximum profit that we are going to have, and it was about breaking our break even. So this will be our maximum profit, but our range we are extending in this case. And there is one more case where we can average to the perfect center, which means like we are not going to average it by the ATM of where the market price is now. When I say like a perfect center of averaging, what I meant is, say now market has moved 600 700 points from where we started our position. So another 700 points if we move, it would be like 33,900. So we are going to do another set at keeping that 33,900 as our center sell points. So we are going to sell 33,900 call and put, and we'll be buying 1000 points away in both sides, which is 32,900 put and 34,900 call. So once you do that, we get something like this, kind of a Batman kind of a payoff grid chart, in which we are in the center point. So both the sides will be in profit if it moves a little. If it is totally neutral, we will not get any profit, but we don't get loss as well. But if it moves little in either direction, we'll be in profit. But if it moves more, we will be in loss. So you can see the payoff, what is the break even here? Break even from 34,641, it is 33,489, and here it is 35,959 to 35,711, and max profit is 10,000. Max loss is again minus 14,000, not that big as last case that we saw, but still it is big because again we are having two set. The next one is called martingale. I have explained a video on two videos on martingale as well. If you want, you can go and check there. I'll explain what martingale is in this example. So in martingale, what we do is like the loss making sell side will just close, and we do twice selling in of to get the same premium, which is like we are closing one lot of 35,300 put at 860, and we will sell two lots of a put option that is available for 430 premium, around 430, which means we'll be getting the same 860, but we'll have two lots of put. So 430, we'll see where we are getting. We are getting 456. Okay, we'll just take that as somewhere around 430. So once we do this, again we are going to have a payoff graph like this, where our break even in the downside is extending. But here the case is like we have two legs of put option sold. So if market keeps going down, we might have an undefined risk. It can be go to any extent. If we keep doing martingale, then yes, we can escape from that, but that requires large number of capital, and it is very difficult strategy. It is not a difficult strategy, it is kind of it needs more capital. You can see those videos to understand better. So as I said, like here the max loss can be undefined, but here you're extending the range from 34,641 to 34,190, and in the upside again we are increasing the range. So this is a case where we are extending the range in the both sides, and max profit also is increasing. Max loss is reducing in one side, and max loss is undefined in the other side. Then we'll go to a strategy that is a ratio spread. So in ratio spread, what we are going to do is, once the break even is breached, we are going to buy one ATM put, which is 34,600. So we will buy 34,600 one lot, and whatever price we have paid 456, we'll just consider as 460. We divide it by 2, and we are going to buy 2 times of that. So that is called 1:2 ratio. So we bought 1 and we are going to sell 2, so that if it goes in the upside, it is not going to disturb you at all, because both these premiums will become 0. But if it is going down, for till some extent, that till the sold leg is coming, we'll be in profit because you have bought one leg put option. So if we feel like market might go down, but it might not go down so drastically, we do this strategy. So once we do this strategy, you can see the payoff graph like this, where we have extended the downside risk, and if it keeps going in the downside, we'll have a unlimited risk, and in the upside again, it is like only 7,900. So once we do the strategy, you can see like the downward risk from 34,641 we have increased to 33,709, and in the upside also we have increased to some 30 points, and our max profit also has increased to an extent, and our max loss one side is decreased, but the other side it is undefined. So similarly, ratio spread we can do 1:2 or 1:3, 1:5, whatever we want. I'll explain two of the ratio spread here. So instead of here like buying dividing the 460 by 2, if we just divide that 460 by 3, which is almost 150, so we are going to buy 3 lots of 150 put option. By doing so, we further extend the downside risk. We'll be increasing the, sorry, we are selling that. I have mistakenly given this as buying. So where we get as 150, we are going to sell 3 lots. We have bought 1 lot and we are selling 3 lots. That is the reason we'll be getting undefined risk. You can see like break even has further increased in the downside, and our loss also you can see here, like last time it was 33,719, here it is further 500 points almost we are having our break even, and upside it is absolutely not a very big difference, and our max profit is almost remaining the same, and loss is also like almost same where it was in the old case, and other side it is undefined as I told before. The next strategy is butterfly, and in this butterfly, when I say like we can just like you have sold 2 legs, right? I think I have in this example I have given 1:3:2 maybe. Okay, we'll just do, as we already have these 2 legs. The other one is like we have to buy some. Now we have 1 lot of sold extra and 3 lots. 1 lot we bought and 3 lot we sold. So 2 lots if we buy again, this unlimited risk will become limited risk. So we are going to buy 2 lots. Maybe again here we have like 1,000 points difference. So we will again go 1,000 points and we'll buy 2 lots. So 32,600 we are going to buy 2 lots. If we do that, the loss will not become unlimited, but it will be a defined loss, as you can see, like, but still it is a very big loss, and our payoff graph will look like this. And you can see like I think this is the example. Yes, this is the same example I have taken before also. So our break even has reduced in the downside, like from 34.6 to 33.318. That is a good thing. And upside not really, doesn't matter, it has not moved much. Max profit is 14,000 and max loss in one side is 10,000 and the other side is 35,000. At least it is not like unlimited risk. And in the center point also we are having a little loss. That also we need to be taking into mind, so that if it is totally neutral, then we might end in a chota loss. So this is the butterfly strategy. Then other strategy is naked selling, which is the normal basic strategy that people do. Let's explain you. Hope everybody knows that, but just a recap for you. So once the break-even is reaching in the lower side, then generally what we do is like we sell a call to get little more premium and increase a little more break even. So here what we do is like we'll just go 500 points above from the ATM. So 34,600. So 3,500 will go, and we are going to just sell one lot of call option. So as we have sold one lot of call option extra, our risk is going to be unlimited in this direction. But this direction, it is going, our loss is reduced to only 2,000, and we are extending our break even as well. So as I said, like we are, if it keeps going downside, our risk is going to be maximum of 2,000. But if it reverses, it is undefined. And here we are little extending our break even as well. And this side, it little reduces as because we have sold a call. Next is credit spread. So credit spread is like, as I said, like in the case of butterfly, and like when ratio was having unlimited risk, we buy 2 legs for OTM to make it risk defined. Similarly, we have sold a naked call to make it risk defined. Again, we are going to buy a call 500 points further. So 35,600 call, let's buy. So once we buy 35,600 call, our risk will be defined in this direction, and this again will be like a maybe like initially it was 8,000, it has reduced to 5,000 loss, and little we are extending the break even as well. And if it reverses, obviously we are going to end up in a loss, but this is a risk defined loss. You can see the how the old and new numbers change. And the final strategy is debit spread. Debit spread, in this case what we do is like we buy a put at the break even, which is 34,600. So we buy 34,600 put option, and we sell 34,500 put option, like hardly 550 point. Maybe we can extend the strike also. Once we do that, our payoff chart will look like this, where if it reduces also, like we'll have little loss, but if it keeps going in the downside, we are going to have a big loss. But if it goes the other direction also, we are going to have a loss. But only thing is like if it is reducing little bit, and if it is bouncing back, we will be in profit. So I mentioned like the break even is like almost the same, but as you can see from the payoff chart, till maybe like it is 34,600, 34,500 or 34,500, we are going to have a very minimal loss of 2,200. If it extends, then yes, we are going to end up in 7,000 loss in one side and 9,600 loss in other side. So these are some 15 strategies that I have discussed. Maybe this might be like you would have already known, or it might be a little overwhelming, but you can know that these are the type of adjustments that are available. So people who have so much money, they can like try and defend their position. They call these as firefighting techniques. These will be available in almost every videos, like in open platforms. But the main thing is like when to use what is something that nobody tells and nobody can tell. That is the absolute truth actually, because we don't know market is where the market is headed. If we know that everybody is going to make profit, but as we don't know, but just to defend these things, we keep these adjustment techniques. And few of these adjustment techniques we can keep repeating, say like averaging, you can keep doing more lot if you have more money. Same with martingale, same with ratios, but these strategies require more capital. But yes, if you have more capital, and if you're taking, if these are also undefined risk also. So if you are having more capital, and if you're also like ready to take more risk, as you know, like more risk and more reward will be there, you can do these type of adjustments to make your profit. In this slide, I have given everything in a little bigger font and everything at one place, so that you can use this whenever you want to have a reference on this. I have also highlighted few of these strategies where we are having the maximum break even. So when you can see like averaging and ratio spread and butterfly, these strategies have the maximum downside break even. And in the upside, you can see again ratio spread is having. So you can see like ratio spread of 1:3 is having extending the range both the direction, the downside as well as upside. But the problem is like it is having undefined risk in the upside. So we have to be careful about that. Even you can see like max profit is almost the same and max loss in one side is almost the same, but this is little difficult. And max profit is like it is more in martingale, again ratio spread and naked selling. So you can just have this as one point solution for all the 15 strategies that we have discussed, and you can use any of this as per your comfort, as per your understanding, as per where the market is headed. There is absolutely nobody can tell like okay, this strategy you can apply here and this strategy you can apply in this type of scenario. It is totally up to you. Only by practice you can do these things. But before doing any trade, it is always good if you know these strategies, and you can learn more about these strategies in any open platform to get more details on this. In the next video, we will see some other informative video. Thank you.